Shares of Lemonade ending the day higher as investors await the company's investor day tomorrow. Lemonade's expected to break down how it'll grow the business from $1 billion to $10 billion in a few years. Well, that stock has had a massive run since reporting its third quarter earnings in late October, up about 90%, but still well off its highs from a few years ago. Joining us now is Lemonade CEO Daniel Schreiber. Daniel, good to have you. So lots of insurance customers are out now shopping for new providers with rate increase notices going out. How has that affected your growth, and how is your technology foundation position you to be efficient about it?
Great to be with you. Our growth has been accelerating. So this time last year, we grew at 18%, the next quarter at 19, then at 20, then at 22. This past quarter announced at 24, and we've guided to a 26% growth this Q4. So steady and rapid acceleration in our growth. And while we're doing that, the underlying unit economics are improving. We achieved cash flow positivity just this last quarter, and that will be sustained. And really, the advantages of all of the AI that we have built is being passed on to the consumer. So we're seeing massive automation. I mentioned 24% growth in our top line, but actually our headcount has been shrinking over the course of the last couple of years. OPEX totally flat and headcount declining, even as we've grown 50% over 2 years. So you're really seeing the dividends of AI on automation play out in very powerful ways at Lemonade.
So how do you grow really at scale without massive marketing spend? I mean, it seems like you got to have a gecko or a duck or a general or something to break through after a certain point.
Well, Lemonade has a distinguished brand. The pink that you're seeing behind me makes us look different. We've got a different value proposition. We appeal to younger consumers with an entirely digital experience. And we also pass on the savings to them. 98% of our policies are sold by an AI. The majority of our claims are paid instantaneously by AI without any human intervention. And that achieves two things. One is tremendous brand acceleration. Consumers love that. They tell their friends. High net promoter scores, which translates into organic growth. And at the same time, lower cost structures, which allows us to pass on savings to consumers. And you get that feedback loop, which really only technology can provide.
So you got a pig, John. There you go. Daniel, it's great to have you on. You're in homeowners insurance, renters insurance, pet insurance, auto insurance. We know, and this has been particularly true on the auto insurance side, that this has been continued to be very inflationary. The premiums have continued to go up, in some cases very dramatically, and the rates. Have we seen the peak? Is it in? Does that start to normalize, dare I say?
Yes, I think so. As inflation rates have come down, as rates increases have kicked in, yes, I think we have peaked. We see that in our own results. Our loss ratio 2 years ago was a very elevated 94% because of those inflationary pressures. We just reported a 73%, which is smack bang in the middle of our target range. So mission accomplished in that side of the house. For us specifically, we have other things that allow us to target risks at a level of particularity and precision that are usually absent in the insurance space. So we're now in the 11th generation of our LTV model, which is basically a composite of 50 AIs, and every consumer that comes in, the AIs make predictions about their likelihood to claim, the size of the claims that they'll make, likelihood to churn, cross-sell, and then you're able to extrapolate a lifetime value and decide which campaigns to invest in, which consumers to invest in. That kind of efficiency does translate into better prices for consumers as well. So as inflation is coming down, I think it was Warren Buffett who said that when the tide goes out, you see who's wearing a swimming costume. We're beginning to see those kind of dynamics. So the huge pain point of inflation is receding, and now you begin to see who's got really the better technology, the better, more prescient systems in place in order to price risk with precision.
So looking at 2025, what does a Trump administration mean for the insurance industry? We were just having a conversation with Randy Quarles about what he's expecting in terms of regulatory changes to the broader financial environment. What kind of policies do you want to see? What are you expecting?
Well, the insurance space is actually governed entirely or almost entirely at a state-by-state level. So we work with 50 different regulators. Really, none of them are federal. But I will tell you that if you look at Lemonade's results since our IPO 4.5 years ago, or for that matter, since our inception 8.5 years ago, you'll see a very steady up and to the right performance, and you'll be hard-pressed to identify any of the tumultuous events, whether it's COVID or the inflation or any of the other massive disruptions and changes of government. We've really been able to prove the industry and specifically Lemonade hugely resilient to those kind of changes. So we're looking forward to a dramatic 2025 with continued growth, increasing profitability, growing our customer base. We don't really expect changes at the federal government to impact our business directly or to derail us or accelerate us in a way that we aren't already doing.
If self-driving cars become a reality more and more over the next few years, what does that do to the auto insurance business?
Well, I think if you're sitting on a $50 billion auto space, like Geico or Progressive or many others, that is an area of true concern. You're suddenly pricing, today you're pricing based on proxies like gender and credit scores and that kind of thing. And suddenly you're not even sure who the customer is. And it might be an algorithm that's doing the driving rather than the consumer. It may be fleet. Everything changes. And I think over the medium to long term poses something of a risk to huge incumbents. Lemonade is in the auto space, but entirely on a telemetry-based business. In other words, we use continuous streams of data in order to price insurance, whether it's consumer driving or an algorithm driving, we don't really mind. And for us, the industry is unlimited, or at first approximation, unlimited in scope. We could 10x our business, 10x it again, and would barely be a blip on the market share. So for us, whether the $300 billion auto insurance market grows or contracts a bit, for the next 10 years will have no impact on us at all. We think we're very well positioned as a technology-first, telemetry-first, AI-first insurance company to adapt to all of those technologies as they emerge.